Joining me right now is CFRA Chief Investment Strategist Sam Stovall. And Sam, it's great to see you this morning. We all want clarity in order to believe that this market has, in fact, seen the worst. Do you have any clarity in terms of what the 2020 earnings picture looks like?
Well, it's certainly getting clearer and clearer, Maria. Right now, expectations are for an earnings recession because the first three quarters are projected to be negative, according to S&P Capital IQ consensus estimates, down 6% in the first quarter, 12% in the second quarter, and then 3% in the third quarter, off 4% for the full year.
Oh, wow. So you are looking at this year as a recession then. You're talking about 3 consecutive quarters of contraction, down 6% in the first quarter, down 12% in the second quarter, down 3% in the third quarter. Do you think we'll see a big rebound then in the fourth quarter, Sam?
Not a big one. We're expecting about a 4% gain in earnings in the fourth quarter. Really, the rebound is expected to be seen by the economists. In the first quarter, GDP is expected to be off around 2%, and then in the second quarter, down more than 7%, but then seeing about an 8.5% jump in the third quarter. So I think the real question is who's right? Is it the economists or is it the analysts with their earnings forecast? But expectations are that it should end up being a V-shaped recovery, just as it was a V-shaped decline.
So you're saying you're seeing a decline, a contraction in earnings for the first, second, and third quarter. But the GDP, actually, the numbers are a little better. Dagan, jump in.
In terms of what you were talking about, Maria, this J.P. Morgan saying that the market route's probably past its worst by now. Sam, let's look at credit, because, again, that's the most important thing to watch other than equities. These spreads on investment-grade bonds, they peaked at 618 basis points during the financial crisis. We're only at 373 basis points right now. That indicates that there's a lot more selling to go in investment-grade credit here.
Well, either there's a lot more selling to go or there's less fear in the credit markets than was seen in 2008. I think, remember, back then, you really did not have a Fed that was as responsive as the Fed is today. You also had concerns about all of these derivatives in 2008 that you don't have today. So I would tend to say that you could either look at it with the glass half empty by saying that's much further to go, or half full by saying it's not going to go that low, because that's not where the fear is.
Mitch, jump in.
Yeah, and I'm going to, Sam, good morning. I want to stay on that credit topic because we had a guest earlier talking about credit cards, forbearance. We have a lot of retailers potentially not paying rent. So the credit market isn't just corporate credit. There's a ton of structured product out there where we've securitized credit card loans, auto loans, mortgage-backed securities, either commercial or residential. As those credit spreads start to widen because there's fears of defaults in that space, how does that ripple through all of the credit markets?
Well, good morning, Mitch. Obviously, those are concerns. That's probably one market did as poorly as it did during this for the S&P 500. But also take a look at S&P Global, SPGI. You can see that it has responded quite nicely, is down substantially less than the market as a whole. So I would tend to say that investors are voting with their pocketbooks by saying that the credit situation will probably not be as bad as many people are anticipating. Look more toward real estate and rentals and so forth as a guide for that sector. But in terms of credit, again, it seems as if investors are not as worried this time around.
All right, we will leave it there. Sam, thank you for the info. Great to talk with you as always, Sam. Thank you. Sam Stovall joining us there from CFRA.